We're at a close to a 10-year low in home buyer demand in the US housing market right now. And in certain cities, home buyer demand is down 50% year over year. We have half as many buyers today that we did a year ago. And of course, that is now causing prices to go down. It took a couple months for these price declines to get going, but we are now firmly in an era where home prices are going down in America. And people really need to start understanding that if they buy a house today, it's very likely that the value of that house 3, 6, 9, 12 months down the road is going to be lower than it is today. And certain cities have already seen very, very big price declines. Mortgage rates have had a huge impact on home buyer demand and home prices. But what I don't want people to believe and think is that it's only related to mortgage rates. What you got to understand is that we're at the end of a 10 to 11 year housing expansion cycle right now, where we've used up a lot of the home buyer demand, especially over the last 2 to 3 years. People who would have purchased in 2024 or 2023, they purchased already in 2021. So an additional thing that's occurring in the housing market, yes, higher mortgage rates is pushing buyers out, but a lot of the buyers have already purchased. From a demographic standpoint, there simply aren't enough home buyers left in the US housing market. And that's a situation that's going to worsen as the recession gets worse as well. So, this increase in mortgage rates has had a huge impact in 2022. But as you said, this is inning one, inning two of a multi-year housing correction that has a lot of different things going on behind it. It was the pandemic, right? I mean, it was logical for a while there in 2020 and 2021 to want to move out of your apartment in the city and go buy a house in the suburbs or a rural area. That made a lot of sense during the pandemic, especially with record low mortgage rates. So that induced forward a lot of demand for both home buyers and eventually renters, which we'll talk about later in this video, the decline in renter demand that's occurring right now. And so structurally, there's just not as many people looking to buy, and especially to make that move across America, whether it's from California or New York to Texas or to Florida. There's just not as many people, period, left to make that move right now. And this is how housing cycles work. Whether you go to the big housing crash in the mid to late 2000s, or you go to the regional housing crashes we had in the early 90s, it always works like this. The mortgage rates go up, the home builders go crazy, just as the structural buyer demand goes down. And that leaves you with a big housing crash where prices have multiple years of declines ahead. We're seeing a huge slowdown in migration, especially from those states like California and New York to states like Tennessee, Florida, and Texas. I was just in Tennessee for the last 2 weeks, and I looked at Nashville, I looked at Chattanooga, I looked at Knoxville, I talked to realtors, and they were all saying the same thing. Huge slowdown in those inbound buyers coming from other states, which is a huge problem because these local housing markets where, a lot of the local population does not make a lot of money. We're talking about, median household incomes of $40,000, $50,000 in some cases. Well, it was the inbound buyers from California making $300K who purchased the homes in cash and pushed prices up 50% in 2 years. Well, who's going to now buy that house at a 50% premium? It's not going to be the local home buyer who's making $50,000 a year. And so that means that prices structurally are going to have to go down in many of these markets and go down by a lot more than they have already. I think we're in the beginning stages of seeing the reversal. So let's just say the slowdown in people moving to those areas, we are well into the slowdown. We are now also just beginning to see the reversal. So when you look at inventory data by zip code, for instance, and by county, the zip codes in the counties in America with the biggest increase in homes just sitting vacant on the market are all of these suburban and rural locations in a Tennessee, in a Utah, in a Phoenix, in a Texas. So that's indicating what we're talking about here. Number one, the slowdown in migration buyers. But then number two, like you just said, we're now seeing people move back to the city, especially of maybe a younger population. When you think about the recession, right? When you think about what's happening with remote work, slowly but surely, more people are getting called back into the office, and slowly but surely, more people are getting laid off. I mean, imagine if someone had a remote job. I'm sure many of your viewers do, and maybe someone had a remote job and they moved from California to Tennessee because their job was remote, and then they got laid off. And they don't have any professional contacts or network in Tennessee. Well, what are they going to do? They're going to move back to California where their family and their professional network is, right? And I think we're going to see more and more of that as this recession gets worse. And we're going to see a trend where people actually want to be in the places where the jobs are, a reversal of what occurred during the pandemic. And I'm not saying remote work is going away, forever. Clearly, some element of it is here to stay, but we have clearly passed peak remote work. That is in the rearview mirror. Peak remote work occurred in 2021. Each year from here on out, the amount of remote workers is going to go down. And that's going to have a big impact on which housing markets have the biggest crash. We're already seeing mortgage rates start to go down from 7.2 to 6.2, still very high. But from what I'm seeing in the trajectory of the economy, in a recessionary environment, interest and mortgage rates on the long end tend to go down. And I know that sounds contrary to what Jerome Powell is saying, right now about how they're going to keep hiking rates and keep rates high. But when you look at long-term bond yields, they're going down. They indicate that this is going to be a pretty big recession. And eventually, I believe the Fed is going to be forced to pivot, which is going to cause mortgage rates to go down in conjunction with a recession that drives people to buy long-term bonds, which further pushes mortgage rates down. So I wouldn't be surprised by the end of 2023 if the mortgage rate is back down to around 5%, maybe the high 4% range. And I actually want to just address a point there. There's a lot of people seem to think housing market is just 100% linked to mortgage rates, right? And so rates are up, so they think housing market's down, and they think if mortgage rates go back down, housing market's going to go back up. It does not tend to work like that in housing downturns and recessions. If you go back to the last crash from 2007 to 2012, mortgage rates went down throughout that crash from 6% all the way to the high 3% range. That did not stop the last housing crash.
Right.
You will 100% have a bust as rates go down. This is what happened in the regional housing crashes in the early 90s. The bigger thing that starts occurring is what I said earlier. We ran out of home buyers. We're running out of home buyers structurally. Our population isn't growing enough to support all the home building, right? Those things start to take over. In addition, a declining price environment, that trumps everything, right? If more and more the mentality gets baked into people's minds that home prices are going down, mortgage rates could go down from 6 to 5, but there's no incentives, there's no push, there's no rush. In fact, if the mentality becomes that both prices and rates are going to go down more into the future, well, then actually you have very little incentive to buy today. Yeah. And in the end, right, it all comes back to the fundamentals. These things we're talking about are kind of like, ideas and theories and speculation, but it comes down to the fundamentals, right? How many jobs are there? How much money are people making? Like, what's the median income? And, how much do they need to pay for a house? And do those fundamentals say that prices are going to go up or down, right? And right now, those fundamentals say that we're still in the largest housing bubble ever. So despite the recent decline in prices, we are still in a bigger bubble than we were in 2006 when looking at inflation-adjusted home prices. So there's a couple of truths to this housing market right now. Number one, prices are going down nationally. That's a fact. And in certain cities are going down already 10 to 15%. That's a fact. However, what's also a fact is that, like you're saying, sellers are still very stubborn, especially in certain cities and certain markets. And a lot of sellers basically saw their neighbor a year ago, sell their house, say, for 600 grand. And the market's now saying, well, it's worth 475. And that seller doesn't want to sell it for 475. They still have this mentality that prices are going to come back up. It's going to be a better spring buying season. Like, that's the one narrative I see floated among a lot of sellers and realtors, is that spring 2023, buyers are going to come back. And, they're telling themselves these things, and that's causing kind of the purgatory situation in the housing market right now that you're referring to. But the thing you got to understand is you got to look at, like, buyers, right? Buyers aren't not buying because of a discretionary choice. They're not buying because they cannot qualify for the mortgages and they cannot afford the homes. That is why buyers are not buying, right? It's not really a choice. Sellers are choosing not to lower their list price in certain cases, right? That's a discretionary choice. And at a certain point in time in the housing crash and the recession, it's not going to be choice anymore for sellers. Layoffs, huge levels of home building, foreclosures, that's going to force even more inventory onto the market. And what I predict is going to happen, it's sometime in 2023, is a lot of these sellers who are kind of thinking like, oh, it's not that bad, they're all going to wake up at once. And maybe it'll be a certain trigger. I can't exactly predict when it's going to be or what it's going to be, but they're going to wake up at once and all rush to cut the price. And the sellers who were delaying listing their homes are going to rush to list their homes. And it's going to be a big, big problem. In 2022, this is a housing market we've never seen before in US history. We have a record amount of homes that are owned by people that don't live in them on a full-time basis. tons of second homeowners, third homeowners, investor-owned homes. Estimates, depending on where you look, from the US Census Bureau or CoreLogic, say there's anywhere from 20 to 30 million single-family homes in America that are investor-owned homes and second-owned homes, where the owner does not live there, right? So think about that. That's a quarter of all single-family homes in America. So think about that in terms of this logic and this thinking about what's going on in the recession. And, these people can easily sell. They don't live there, right? And that's something we actually did not see as much in 06, believe it or not. In 06, we had a higher share of people actually living as a primary occupant in the home than we do now. And so that's something, especially in investor-driven housing markets, that I think could lead to a subprime 2.0 type of situation where the investors all of a sudden start selling. Like we know already, they've stopped buying in a lot of markets. But once they start selling, that has the potential to just flood the market with inventory in a way that's very difficult for people to conceive of right now.